Imagine moving $25,000 from a traditional IRA into a Roth because your federal tax bracket looks comfortably low. The conversion may fit inside that same bracket, but it can still expose more Social Security to tax, shrink a valuable senior deduction, and echo into higher Medicare premiums 2 years later. One decision, 4 different bills. That is the retirement tax domino effect. And the bracket printed on an IRS table shows only the first tile. By the end, you will know how to map the entire chain before you make a withdrawal, conversion, or stock sale in 2026. During your working years, income usually arrives through one large pipe called a paycheck. Retirement replaces that pipe with a control panel. A pension may cover the electric bill. Social Security may pay for groceries. Traditional IRA withdrawals may fund travel. A brokerage account may handle a new roof, while Roth money waits for a later year. Each source can look harmless by itself. The surprise appears when the tax return connects them. Start with the familiar part, the federal income tax bracket. For 2026, a married couple filing jointly has a standard deduction of $32,200. A single filer has a standard deduction of $16,100. After deductions, taxable income moves through progressive layers. A married couple pays 10% on the first $24,800 of taxable income, then 12% until taxable income passes $100,800. Only the dollars above a boundary move into the next bracket. Crossing that line does not suddenly tax every earlier dollar at the higher rate. That sounds reassuring, and it is. But the ordinary bracket answers only one question: how the next dollar of taxable ordinary income is taxed. It does not tell you whether that dollar makes another part of your return more expensive. Picture a kitchen table covered with a pension statement, a Social Security letter, a brokerage report, and a traditional IRA balance. A retiree wants cash for a vehicle, so she takes an extra IRA distribution in December. That withdrawal is generally ordinary income. It may fill more of her current bracket, but it can also push on several other income-sensitive rules. This is why the useful planning number is not simply your bracket. It is the total cost created by the next dollar. The first hidden connection appears when ordinary income meets long-term capital gains. In 2026, the 0% long-term capital gains range extends to $49,450 of taxable income for a single filer, and $98,900 for a married couple filing jointly. Those numbers refer to taxable income, not the size of a stock sale and not the cash deposited into a bank account. Long-term gains sit on top of ordinary taxable income. If pension income, taxable IRA withdrawals, interest, and other ordinary income already occupy much of the 0% space, fewer capital gains fit there. Selling appreciated shares after a large Roth conversion can therefore produce a different result than selling the same shares before the conversion or in another calendar year. The gain did not change. Its position in the income stack did. This is also why a 0% capital gains rate does not mean a gain has no consequences. A realized gain can increase adjusted gross income even when the federal capital gains rate on part of that gain is 0. Adjusted gross income is the number that other systems may notice. Social Security is where the next domino becomes easy to misunderstand. The rule uses combined income, which includes adjusted gross income, tax-exempt interest, and half of annual Social Security benefits. For an individual, federal taxation can begin when combined income exceeds $25,000. For a couple filing jointly, it can begin above $32,000. At higher income, up to 85% of benefits may be included in taxable income. That does not mean Social Security is taxed at an 85% tax rate. It means as much as 85% of the benefit can become taxable at the household's applicable rate. The distinction matters. An additional IRA withdrawal can create taxable income directly and also cause more Social Security to become taxable. For a stretch of income, the tax return may grow by more than the size of the withdrawal alone. Now add the rule that received so much attention from retirees. From 2025 through 2028, a qualifying person age 65 or older can claim an enhanced senior deduction of up to $6,000. If both spouses qualify on a joint return, the maximum can be $12,000. The deduction is available whether the household uses the standard deduction or itemizes, but the full amount does not remain available at every income level. The phase-out begins when modified adjusted gross income exceeds $75,000 for a single filer or $150,000 for a joint return. The deduction then falls by 6 cents for every dollar above the threshold. That means a Roth conversion, a large traditional IRA withdrawal, or a realized gain can reduce a deduction that looked secure in January. For someone who is 62 today, this is not a reason to ignore the rule because age 65 seems far away. It is a reason to build a multi-year map. Income decisions made before retirement can affect the size and location of traditional, Roth, and taxable accounts available later. The best planning window often appears after the last paycheck but before required minimum distributions begin at age 73. Yet even inside that window, age 65 adds Medicare and the senior deduction to the control panel. Medicare creates the longest echo. In 2026, the standard Part B premium is $202.90 per month. Higher income beneficiaries pay an income-related adjustment called IRMAA. For 2026 premiums, the first surcharge starts above $109,000 of modified adjusted gross income for an individual or $218,000 for a couple filing jointly. That first level, Part B rises by $81.20 per month for each affected beneficiary, and Part D adds $14.50 per month on top of the plan premium. The strange part is the calendar. Medicare generally looks at tax information from 2 years earlier. The 2026 premium table normally uses 2024 income. A large conversion or capital gain in 2026 may therefore show up in a future Medicare calculation rather than on the next monthly statement. The exact thresholds and premiums for that future year may be different, so the safe approach is to check the current official table before acting, not to memorize one old number. There is also a relief valve. Retirement or another qualifying life-changing event can reduce household income, and Social Security allows a beneficiary to request a lower IRMAA determination. That request is not automatic, and it does not make every planned high-income year disappear. It simply means an old tax return does not always tell the full story after work ends. At this point, the retirement tax problem can look like a maze of brackets, deductions, premiums, and acronyms. The solution is much simpler than trying to memorize all of them. Build an income dashboard for each calendar year. Begin with income you cannot easily change, such as a pension, wages, required distributions, interest, and the Social Security you expect to receive. Then add the flexible moves you are considering, including IRA withdrawals, Roth conversions, and realized capital gains. Next, check the same proposed total against 5 separate lines: the ordinary tax bracket, the capital gains range, the Social Security combined income calculation, the enhanced senior deduction phase-out, and the Medicare IRMAA threshold for the relevant year. Do this for more than 1 year. A conversion that looks expensive in 2026 may still be reasonable if it reduces larger required distributions later. A gain that fits comfortably this year may be better realized now than after a pension begins. On the other hand, filling every last dollar of a bracket can be a poor target when that move erases a deduction or crosses a Medicare line. Good planning compares lifetime trade-offs instead of chasing the lowest possible tax bill in 1 year. Leave a buffer below any threshold you are trying to protect. Interest can change. Mutual funds can distribute unexpected gains. Part-time work may pay a little more than estimated. A tight plan that depends on landing within a few dollars of a line is not a plan. It is a guess wearing a spreadsheet. Finally, plan how the tax will be paid. Retirement income does not always arrive with enough federal withholding. The IRS generally expects estimated payments when the remaining tax bill will be large enough and withholding does not meet the safe harbor rules. A beautiful conversion strategy can still end with an unpleasant surprise if nobody adjusted withholding or scheduled estimated payments. The tax domino effect is not an argument against Roth conversions, IRA withdrawals, stock sales, or claiming Social Security. Each can be the right move. The lesson is that every flexible income decision should be tested against the entire control panel before the transaction becomes irreversible. A tax professional can model the exact return, but you can arrive at that conversation with the right questions and a clear multi-year picture. The first tile is your federal bracket. The last tile may be a Medicare premium that appears 2 years later. Once you see the chain, retirement taxes stop feeling like random penalties and start becoming decisions you can schedule, compare, and control. Subscribe to Old Smart Money for more calm, practical retirement planning built around the decisions that matter before and after your final paycheck.